It is time. Good morning, everybody. It is Wednesday. Can you believe it? The week is half over already. Today, we are thrilled to be talking about mortgages, Mortgage 101. And we have our dear friend, Reid Clark, who is a wonderful vendor partner in our office. He is a godly man who loves to help people and is a great lender as well. So he's going to be covering how to understand the different kinds of mortgages, especially with all this COVID stuff and what's available out there. So make sure you've got your questions. Please keep yourself muted until he asks a question, or if you have a question, or you can always put it in the chat, but it's a small enough group. Feel free to just jump in and ask. Let's make this interactive. I will ask you to please to show your video so that he can actually see your pretty faces. I don't care if you've been working out, right, Deja? As you can tell, I'm getting ready to work out right after this as well, so it doesn't matter. Most important is just to be able to see each other's faces, okay? So, Mr. Reid.
I have one question before you get started. Mr. Reid and Miss Julianne, are you going to send some like PowerPoint or tip notes from this, or we should take a lot of notes because I'll try my best.
I can send you, I've got a flyer with some general stuff, and I've got another PDF that has a little more detail. I can send those to you. I got to figure out how to get a list of who's on here. How do I do that?
I'll keep a list.
Okay.
Okay.
And Thank you. I mean, I'll have it on the screen too, so you guys can do a screenshot or
yeah, you can always do a screenshot. Yeah, absolutely.
Yeah.
So, all right. Any other questions before we start? Remember to have your video showing so we can see your pretty faces. And Reid, let's take it away.
Cool, guys. I was almost late. I had to do my hair before I got on here, so glad we made it in time. It's pretty simple. But yeah, also too, it's today's Veterans Day, so it's a good day to remember. It's so easy to take for granted what's happened for us to be where we are as a country, to live where we are, where we do. And it's so easy to take for granted what we have here with all our imperfections. If you know much about the rest of the world, we're a heck of a lot better than about 99% of it. And I think we're making progress in many areas that we need to make progress in. So I'm grateful for that. And I'm sure many of you all are too. Given that, I'll start talking about VA loans. That was a good segue into that. So a little bit about me. I've been a loan officer for over 15 years. I moved back to Georgia in 2005 and got in the mortgage business then. A lot of changes over those years. I've been in the Keller Williams office for right at 10 years now, which is probably a testimony to the patience and grace of the people in the Keller Williams office. They hadn't booted me out, but no, I think we've done a good job for the agents in there and are very grateful for those relationships. So my team and I are available for y'all, whenever you need us. There's 1, 2, 3, 4, 7 of us on my team, 8 counting Bruce. And so, we can take care of you guys when you need us. So I'm going to share my screen. Let's see here. I got 3 monitors here, so I'm trying to remember which one I'm on. I'm going to share this one. So this flyer that you're looking at, let's see if I can. Let's see. So you guys are seeing the whole shooting match, aren't you? You're seeing the borders, the everything.
Yeah. Yes, we do, and that's okay. You can zoom in. There you go. Beautiful.
See if we can make that a little bit smaller. Probably not. Anyway, so let's go and talk about a little bit about VA loans. So VA loans are for qualified veterans, and it's a program. In my estimation, it's the best loan program out there. It's 100% financing. There's no monthly mortgage insurance. Let me start actually with that. Raise your hand if you know what mortgage insurance is? Okay, real quickly, what it is somewhere back in the shadowy history of the world, somebody decided that if you didn't make a 20% down payment on a house, that you were a higher risk. And so banks, for years, they required at least a 20% down payment. But about probably 40 years ago, companies came up and said, tell you what, we'll provide something that's called mortgage insurance, and we'll insure that top 20% or however much it is. If they put 5% down and they're doing a 95% loan, mortgage insurance company says, we'll insure that top 15%. So what that did is it gave lenders the incentive to make loans with smaller down payments. It just makes sense. The lender knew that they were only on the hook for 80% of the amount that they loaned. Does that make sense?
Yep.
All right. Most of the time, mortgage insurance is done with a monthly premium. And most of the time, let's say you did a 95% loan, during the course of your home ownership, as you paid the loan down and down, when you got to 80%, the mortgage insurance went away. People call it PMI, private mortgage insurance. So that's what mortgage insurance is. Now, on a VA loan, you don't have that monthly mortgage insurance. They're loaning you 100% of the value of the house. There's no monthly mortgage insurance. Now, there is a funding fee that VA charges, but it's financed into the loan. It's not something that the veteran has to come out of pocket with. So that's what a VA loan is. Now, from a realtor perspective, you sometimes will get a little pushback if you're representing a buyer. You may get a little pushback from a seller, especially if they have multiple offers. And there's a perception out there that VA loans are harder to do, that the house has to be perfect. That's an exaggeration. First of all, VA loans are not that hard to do if the lender knows what they're doing. And I know that sounds self-serving, but it's just a fact. You've got to be dealing with a lender that knows what they're doing. Now, no lender's perfect. Any lender can make a mistake. But having done hundreds of VA loans, we kind of know what to look for up front before we issue a pre-approval letter. Like, for example, there's a document from the Veterans Administration called a certificate of eligibility. We get that the day that we take the application. So we know whether they're qualified. Those are the types of things. So sometimes, let's say that Julianne has a client who's using a VA loan, and she makes an offer and she gets a little pushback from the listing agent, said, oh, Julianne, we don't want to take a VA offer. He doesn't have any skin in the game. He's got no down payment. I heard VA loans are tough. I heard the house has to be in perfect condition. Julianne's already looked at the house with her client, and she says, Susie, I've been in the house. The house looks like it's in really good shape. I really don't think you're going to have any issues with a VA loan.
So you're talking about their concern. You're talking about their concern that it won't appraise, right?
Two aspects. Number one, the value. They're thinking that it may not appraise for the value. But the second thing is that sometimes a VA appraiser will require certain repairs. Now, it's going to be pretty much obvious stuff. Broken windows, roof leaks, stains on the ceiling that indicate a roof leak, ripped up flooring, holes in the walls, water in the basement. A VA appraiser will say, okay, here's the value of the house, subject to these things have to be repaired. But I can tell you 99 times out of 100, it's the things that you would have already seen anyway, and you would have probably put on an amendment to address concerns or as a special step when you wrote the contract. Julianne, would you agree that's been your experience?
Yes, absolutely.
Yeah, you usually don't get blindsided by a VA repair. And the reality is they're going by the same standards that an FHA appraiser is too, because an FHA appraiser also can require repairs. So sometimes in a case like that, there may be a little psychology involved where you have to really sit down and talk to the other agent. This is a case where a lot of times the buyer's agent will ask me to call the listing agent, and I can tell her all the work we've done to pre-approve the client, all that sort of thing. And sometimes that will help. But a VA loan is an accident loan. The interest rates are lower than conventional loans. And at Silverton, we don't charge any lender fees whatsoever. So there's no processing fee, no underwriting fee, no credit report fee. So on that saves the client $1,295 right there. The veteran doesn't have to pay that. So that's the scoop on a VA loan. Does anybody have a question about VA loans?
I do. My husband's a veteran, so we've never used a VA loan. We've always kind of just not using, went with conventional, because we thought that a VA loan, to what you're saying, is more complicated to use and it has to be on your primary resident. Is that a true statement, that it has to be on your primary resident? Because I think that's some confusion too for people that are using VA loans for second homes. You can't do that, correct?
It has to be for your primary residence. It can't be for your lake house.
Okay.
If that's what you're asking, right?
Yes. Mm-hmm.
Yeah, it absolutely does. It's for primary residences. Now, I don't want to get too far out in the weeds, but a client, a veteran, it is possible for him to have a VA loan on a former home, and he could still have enough eligibility left to get a second home. There is a way to do that, but that's not what you're talking about.
Or if they currently have a home that they have a VA loan on, and they have to sell it anyway, they could go ahead and get a new one, correct?
Before the other one sells?
Mm-hmm.
Sometimes. It depends on the amount that's owed and how much eligibility they have left. And there's a supplemental eligibility calculation that we can do to tell them, okay, if you don't sell that house, this is the amount that you can buy before you sell. So there's cool. a calculation.
Now, one other thing I wanted to ask about VA. As an agent, if someone tells us that they're going to be using a VA loan, what questions should we ask them so that we know that they're prepared and that they can actually qualify for a VA loan?
You know, Julian, you know kind of what I'm going to say on this, because we've this in our first rodeo together. I'm going to say, if I was a realtor, I'd say, who's your lender? And I would sit down and talk with them, because I would want to make sure that the lender has really done the legwork to know that they're pre-approved. You know, I don't want the real estate agent to get too deep into the mortgage part, but and I know that's your perspective too, Julian, because if you guys say something or you make a mistake, I promise you they will remember and they will hold it over your head. Or they may decide at some point, well, she doesn't know what she's doing, or he doesn't know what they're doing, I'm going to find another realtor. So I would typically, you know, I mean, you could ask the question, do you know you have VA eligibility? And if they say something like, well, I was in the service, well, that doesn't necessarily mean you have VA eligibility. What service were you in? Were you in the reserves? How long were you in the reserves? Because you got to have 6 years of service to be in the reserves. Were you active duty? You know, it's a shorter time period. Sometimes there's an assumption made that they do have VA eligibility and they might not. Right. But I mean, the best thing I would do is to say, who's your lender? And I would try to encourage them to use a lender with whom you are familiar. There are several big companies that do an amazing marketing job to veterans, and they will gravitate toward them. They even have veteran in the name of the mortgage company. Veterans United is one of them. They do a jillion VA loans, but it's a call center. It's not like Julianne, who can get her favorite lender, whoever that may be, on the telephone when she needs him. You know, I mean, she's going to call me and she's going to get the straight scoop. She's going to call Veterans United and she's going to be talking to somebody she doesn't know, who may or may not give her all the info.
And that is really important, is to be able to have conversations with your lender, for sure.
I think it is too.
But just because someone served does not mean that they are eligible for a VA loan. Mm-hmm. And that's the one thing I wanted them to know, is that they definitely need to talk to the lender.
Yes. And most of the time we can go in, we have a login to the VA portal, and we can pull the certificate of eligibility almost immediately. But if not, then we have to get a couple of forms from the veteran and we send it to the VA for research. And then the certificate of eligibility can come after that. So there's a process involved in it. Don't be scared of VA loans. Don't be scared of VA loans.
Last question. how long does it take for them to get their pre-approval letter for a VA loan if they're
Most
looking
of the time, most of the time it's the same day.
Okay.
And that's when I will let, I would let you know, Daisha, hey, I've done a pre-approval on Mr. Smith. Everything looks fantastic. Only one thing, I couldn't pull his automated certificate of eligibility. We're going to have to send in his DD 214 to get that from the VA. That could take several days. I mean, it's going to be a few days then before I can give you his pre-approval letter.
Okay.
So, but that's not very, I'll tell you where you run into that is with older veterans. The records don't seem to be as good. If you get back into a Vietnam era veteran or earlier, some of those can be difficult. And there was, believe it or not, there was a fire in an archive, in some VA archives years ago. And I have had one or two that were, probably more like early Vietnam War, Korean War veterans that it was really hard to get the documentation. I actually had one where a guy at VA headquarters, they couldn't find his documentation and they just gave him the eligibility anyway. And I know they didn't have what they needed, but they gave it to him. So, yeah.
So one last question about VA. As an agent, when we're filling out the financial contingency, is it still, I mean, for you guys, I know it varies depending on the lender, but is it still around 21 days or do you need longer for a VA loan?
No, you don't need any longer. Yeah, I mean, typically on most contracts, we would say 14 on appraisal and 21 for financing. And even with the extension of underwriting turn times that's happened over the last 6 or 8 months, it's coming back down a little bit now. So that typically is plenty of time, but it doesn't take any longer. Unless, like I said, Julie, unless it's an odd circumstance where, we have to try to research to get his certificate of eligibility, but it's not a longer process. Cool. Anything else, anybody? Okay, well, since we're talking about government loans, let's talk about FHA. Well, let's go with USDA next, because I can do that one quickly. The short version is you're rarely going to deal with USDA loans. They're in rural areas. Most of you probably are not going to be selling in those areas. If you ever do, you can do a Google search for USDA mortgage property eligibility, and there's a interactive map where you can put the property address and it'll tell you whether it's in an eligible area or not. It also is 100% financing. It has income limitations. The automated underwriting on a USDA loan is a different system. It's called GUS. I guess that's government underwriting system. It's quirky. If you ever do have a USDA loan, even if it's not me, call me and let me give you guys some pointers on it, because I will always try to help you, even if it's not me using, not using me for the mortgage. If I can help you, I will. I mean, I'm in the office. I'm grateful to be in the office, and I'm not just there to do loans for you. I'm there to be a resource for you. So a USDA loan, it's a good loan. That one is a more difficult loan. I'll give you that on a USDA loan. But again, you're not going to be dealing with them very much. FHA loans we'll deal with a lot. FHA loans make up a big percentage of the mortgages that are originated. Not mine. Most of my stuff is conventional. We do a lot of FHA. We have several in process right now. FHA loans have a broader criteria for approval. In other words, you can have a lower credit score and get an FHA loan. We do FHA loans and VA loans down to a 600 credit score. Right now, most lenders are at 640 or higher. We'll still go down to a 600 on an FHA loan. Your debt to income ratio on an FHA loan can be higher. It's crazy, guys. So I've seen FHA loan approvals with a debt to income ratio as high as 56%. Now, here's what that means. That means with the new mortgage payment and all your other monthly bills like credit cards, student loans, car loans, all that sort of thing, you can have an indebtedness that takes up 56% of your gross monthly income. Gross income. Now, guys, if your gross income is $10,000 a month, how much do you think you're actually bringing home after taxes? 70-something% probably. And your mortgage, your indebtedness, you can qualify for an FHA loan with a debt to income ratio sometimes as high as 56%. It's crazy. I promise you this, you wouldn't loan your own money in a circumstance like that, because those are the ones that scare me a little bit, that I'm afraid people won't be okay. I'm afraid that something will happen in their life and they won't be able to make the payment. But we will absolutely work with them to get them in a home. I mean, just because I have a personal concern doesn't at all, slow me down from helping people get into a house. Try to have those conversations with them, but ultimately it's their decision, and we want to help them get in a house. An FHA loan you can get in with as low as a 3.5% down payment. So 3.5% down payment. The money can be gifted to them for the down payment and the closing costs. The interest rates on FHA loans typically are very good. There is monthly mortgage insurance on an FHA loan. You can qualify more easily for an FHA loan.
And that amount is 1.75%.
Okay. What she's talking about is there's two types of mortgage insurance on an FHA loan. There's monthly PMI, like we talked about earlier, and there's something that's called an upfront mortgage insurance premium. I wish, you know what, next time I do this, I'm going to try to have a FHA financing contingency form from the contract. I wonder if I happen to have it. Let me see if I've got one real quick, because there's a place on there, and I get called on it all the time. As for, let me see if I've got one. I don't. There's a document in there that
it's on the first page at the bottom, and it asks for percentage, and the amount that goes in there for now is 1.75%.
1.75. So what it is, guys, is 1.75% of the loan amount is actually an upfront mortgage insurance premium that's financed into the loan for an FHA borrower. That's probably more details than you needed. Can y'all see that conventional?
Yep.
Okay. Well, that doesn't help any.
Nope.
I've got it on there, but it doesn't help you any. So I don't think I have an FHA one. So.
That's all right. And I review all of their first stuff anyway, so I'll always make sure that that's filled in.
Okay. What questions do you have about FHA loans?
We've got one. Monique, can you ask, or do you want me to ask for you?
Yes,
Okay.
I'll ask.
Okay.
So I have a client who's FHA approved right now, but we're running into the issue of the price point that she's looking to buy in. The houses have been flipped. So literally they've been bought in like September and put right back on the market at the beginning of October. So we're not in that 3-month mark. So my question is, will my client, or clients are in that situation, be able to go under contract and then close after 90 days, which I'm sure they probably can't, or do they have to wait 90 days and then go under contract?
Yeah, you can't go under contract until the 90. Yeah, you can't go under contract until the 91st day since the last change of ownership.
Can they even submit an offer? Like, let's say it's right on the cusp. Can they submit an offer as long as it doesn't go under contract until on day 91?
That's my understanding. Now, what I've told people in the past is, if they're communicating with a listing agent, a good listing agent and a good seller is going to know this. Now, but you're going to be surprised how many times they'll come back and say, "What are you talking about? I've never heard that rule." Come on. Seriously. So it's called the anti-flipping rule. And so you can't go under contract, so you can't be binding until the 91st day after the last change of ownership.
And it doesn't matter what the other change of ownership got, whether they paid cash or any kind of loan, it's all about FHA, correct?
Yes. And there's,
okay.
and a lot of times, if there was a really big increase in value between the last change of ownership and the last sale and the current contract, they're going to have to document what they did to the house. For example, a list of all the repairs. Typically, they're not going to have receipts, but they many times an underwriter might ask them to list the repairs and the approximate cost of those repairs. I have seen before where an underwriter asks for a second appraisal to substantiate the value. If that ever happens, the borrower can't pay for it. So those are the conversations. A good flipper knows this, but you could run into it. So yeah, you don't need to go binding on a contract, Monique, in that situation until the 91st day. And is it certain that they absolutely can't go conventional?
Yes.
Okay.
We've already gone down that avenue.
Yeah, I spoke with the lender and she said that she wouldn't be able to go conventional. So that option is out. So when I spoke to the listing agent, they said that the only other options were conventional or cash. So we found another property and we just looked at it. That's where I'm headed from now. And I believe today is the 90th day. Either the 90th day or tomorrow will be the 91st. But we're within that time frame.
Gotcha. Well, good luck. Good luck.
There was one other question I had on my brain about FHA.
Okay.
So here's a question. So first thing we did with Monique's situation is we went to the lender and said, is it possible for her to qualify for conventional?
Right.
And if they say no, does that mean that all lenders are going to say no?
No, it doesn't. And especially right now, because it could be that they're one of the lenders. And I've seen this, and you know where I'm going with this, Julianne. There are lenders right now. When COVID started, most lenders could do an FHA loan down to a 580 credit score, except for some of the banks. The banks typically will be more conservative. When COVID hit, virtually every lender that I know of raised their minimum credit score on FHA loans to at least 640, some higher than that. We're still doing them down to a 600 score. So it could be in that circumstance, Julianne, that the only reason they can't qualify for an FHA loan with that lender is that maybe their minimum credit score is 660 or 640 and they're just under that. So that could be it. It might not be that, but it could be. It doesn't. No, just because one lender says they can only qualify for FHA doesn't
That's
mean.
a good point. So
Yeah.
In Monique's situation, we may want to have her talk to a couple of other lenders and see if she's got other options, because we're going to run into this over and over again for her.
Or talk to that lender if you've already had a conversation with him and ask him specifically, him or her specifically, Kate, can you tell me what the issue is? And if it's her debt to income ratio is 53%, then yeah, she's going to have to go FHA. If it's a decent loan officer and they've done their work to make sure they can't pay something off and get their debt to income ratio down or something like that.
Okay.
So it's worth asking.
I'm sorry.
Go ahead.
I was going to say, as a follow-up to that, I think I was just trying to clarify, the difference between why someone needs to go down the path of an FHA loan. But based on what you guys are describing, it sounds like it's more about their debt to income ratio or their credit score that may drive them down that direction as the two main things. Would that be a good assumption?
90% of the time, yes, because you can do a conventional loan with a 3% down payment. So it's typically not because they don't have enough for a down payment. The only other thing it could be is that waiting period after a bankruptcy or foreclosure is shorter for an FHA loan. So it's usually a credit issue or a debt to income ratio issue.
Okay, but the conventional loan and the FHA loan down payment wise can come fairly close to each other right now?
Yeah, they can. Mm-hmm.
Okay.
Yeah, also, if somebody owes money on their taxes, conventional is going to dig deep into your taxes and make sure all that's straight. FHA doesn't care.
So yeah, just ask a lot of questions and see if you can get the lender to give you, and maybe even a conference call with the client so the lender will know that they can talk to you.
And then the last question I have about an FHA loan, because I'm trying to identify like what customers are probably fall in this category. Would you say a lot of people that have a lot of debt because of like student loans, trying to start their home or start their family, they typically are better for that because their debt to income may be, higher because of the fact that they have so much debt from school, and this may be the only option they have at this point? Or would you suggest that they should try to look at all the loan options and see what comes out as the best option, or the loan officer should advise them is probably the best answer?
Yeah, absolutely. That's the answer. I mean, you're right, what you said. I mean, if they've got a ton of student loan, it may be that an FHA loan's the only way to go. But a good loan officer is going to figure out, because our compensation is not based on what type of loan or anything like that. We want to help the person get into the best loan for them. And so, yeah, I mean, having a good LO is really probably your best insurance.
Okay, thank you.
Okay, so what can you guys see on the screen now? Do you see, is it this blue and white flyer? Or what are y'all seeing?
We're seeing the one where it shows the FHA and then the USDA rural financing is right underneath it. Yeah, I can see that.
Okay.
Yes.
So this right here, this is the downside to an FHA loan right here, right now. The monthly PMI on an FHA loan is permanent. You remember how I said earlier that the PMI goes away when you've got the loan paid down to 80%? Well, about 6 or 8 years ago, that changed. And we were stunned in the mortgage industry, honestly, when monthly PMI became permanent, because before then it did go away and now it's permanent. So you could theoretically have a person who lives in a house for 25 years, they don't ever refinance, and they're still paying FHA PMI every month, which is just nuts to me. Now, if they put 10% down, yes, it'll go away after 11 years. But most of the time, people aren't putting 10% down on FHA loan. So, and the loan amount in the Atlanta MSA is $401,350. So that's a lot of house with an FHA loan. I've even had people that, had tons of money and put $100,000 down and got an FHA loan because they'd had a bankruptcy. Their bankruptcy or their previous foreclosure was too close and they couldn't do a conventional loan, so they did an FHA loan and made a big down payment. That's pretty rare too. Okay, anything else on FHA? And there's VA. So conventional loans. This is the current loan limit for a conventional loan, $510,400. It's going to be going up, we're told, next year. And it looked like it was a pretty decent increase. I don't remember exactly what it was because it's not finalized yet. $510,000 loan, they can get a conventional, conventional financing. In general, it requires a slightly higher credit score. I've got in here over 660. I mean, you can get a conventional loan with lower than a 660, but unless you're putting 20% down, the PMI is what's going to cost you a lot. So it allows for a lower debt to income ratio. Shouldn't say requires. It allows for a lower debt to income ratio. 49.99 is the maximum loan to value or debt to income ratio for a conventional loan. I've got one right now where the guy's actually going to have, we had him at 2.875, and he's actually going to have to buy the rate down to 2.625 to get him to 49.97 so he can qualify, because it has to be under 50%. Down payments on conventional loans as low as 3%. PMI does go away when the loan is paid down or the value of the house goes up. This is your standard Fannie Mae and Freddie Mac conventional loan. I mean, that's kind of your plain vanilla right there. Any questions on that?
This is pretty simple. The conventional loan typically is kind of easier to explain. The only question I have about is the loan limit. So I think it's probably going to speak to the jumbo, but ultimately, let's say if someone's looking at a house at 600,000 and they only are putting 3% down. I'm just making up a number right now. I'm not doing the math, but ultimately if it exceeds the 510, 400, then, and they don't have the right amount down to keep it underneath that 510, then they have to go and do what? Do the jumbo? Is that where we're going with that? Because I'm trying to understand the limit on the conventional loan. So if you have a house that's more than 510, you can't just basically get that whole mortgage lended by the lender. You have to do something else creative.
Yeah. So
Okay.
let's say that it's a $600,000 purchase. And let's say that Mr. Smith says, look, I've only got 5% down. That's okay. We do a first mortgage for 80% of the value and a second mortgage for up to 95% in that
Okay.
case. So
Got
you
it.
can do it. He's going to have at least 5% down, and he's not going to do a jumbo loan. He's going to do a conventional loan with a first and second.
Got it. Okay.
Yeah. To get him up to 95%. Jumbo loans right now, in general, you're going to have a 20% down payment. There were smaller down payments pre-COVID, and they may be coming back. But right now, when I'm talking to someone, I'm saying, look, if you're doing a jumbo loan, like I did one, I've done $1.1 million purchase last month, and they had to put 20% down. And of course, they had sold their other house, so they were okay with that. And so we'll go ahead and transition over to jumbos. Loan amounts over 510,400. The debt to income ratios have to be lower. You cannot go up to 49.9. You're probably going to be in the low 40s. You're going to be capped at that. You're going to need a higher credit score. You're going to probably need a 700 credit score to do a jumbo loan. There may be some outlier mortgage companies out there that are doing different stuff than that. You're going to see high interest rates on things like that. But in general, this is what you're going to need to have. And you're going to have some reserves. You're going to have that. Say it again.
Can you explain the difference between conventional and a jumbo? I guess those two don't sound that much different other than the limits and the rate.
That's the main issue. Conventional loans are governed by the rules from Fannie Mae and Freddie Mac. Jumbo loans are governed by the rules by the particular investors who are going to service those loans. For example, right now, we can underwrite in-house jumbo loans for SunTrust/Truist. So they're going to service that loan, so they make the rules as to who can qualify. It's not Fannie Mae and Freddie Mac.
Got it. Okay.
Chase, the other one we do Chase jumbos. They set the rules for that. So that's the main difference.
Got it.
When it says more reserve assets, is that property? Is that stocks, bonds? I mean, what does that mean exactly?
Typically, it's like a retirement account, money market account. It wouldn't be hard assets. It'd be liquid or semi-liquid assets. I mean, it could be a stock account, something like that. Your 401k is certainly going to have stocks in it, so that can count as reserves typically. I mean, some jumbo lenders require, if you got to have 18 months reserves or 12 months reserves, they require half of it to be liquid. So, we have to be careful on stuff like that. But that's the same as a
down payment.
Say it again.
What's the typical down payment on the jumbo loan? It says higher.
20%. Yeah. Right. Yeah. But I mean, if somebody's, frankly, if they're buying a, $800,000 house, they need to have a little more skin in the game, because if you think about it from a lender's perspective, if they ever have to go and foreclose and sell that house, there's a lot less buyers at that price point. It's going to be easy to sell a $350,000 house if you have to foreclose. $1 million house, if you have to foreclose on it, there's a lot smaller pool of people who are going to want to buy it. So there is more risk involved. That in general is it. Again, the best advice I can give is get comfortable with a lender, build a relationship with somebody you can trust who's responsive, and rely on them. I mean, I'm just being honest, because you need to know a little bit about mortgages, but you really don't want to know a ton, and you certainly don't want to communicate to your client that you have all the answers on mortgages, because like I said, number one, things change, and number two, it's just easy to make a mistake. And if you tell the client something that's inaccurate, you know how human nature is. They will remember it. They ain't going to remember all the good things you did for them. They're going to remember any mistake you made. So that's what I would suggest.
I have a question.
Yeah.
So for a person that doesn't have credit, are they able to do FHA? Like, are they able to get one of those loans, or do they have to go a different route?
No, if you don't have any credit at all, right now, you can't get a mortgage. You have to have a credit score. So sometimes with that person, we just say, hey, look, here's what we would suggest. Go get a secured credit card, which, I mean, I just had to do the same thing with my son. He didn't have any credit. So he went and put $300 on deposit at the bank, and they gave him a credit card with a $300 limit. And, you know, after 3 or 4 months, all of a sudden he has a credit report and he has a credit score. But
So you don't need a long history?
You need to have usually a 12-month history. Yeah, but it doesn't have to be high dollar amount. That credit card I just described for him, technically, after he's got a 12-month history on it, if he could qualify in every other way, he could get a mortgage for that.
So if someone's got a 25% down payment on a $300,000 house and a 500 credit score, I mean, is that possible?
No, they've got to have at least a 600. Now that'll change, Jim. I mean, when things loosen back up, but it's never been, well, I take that back. Back in the Wild West days, back in the mid 2000s, Lord have mercy, there were people getting loans that you just would not believe.
Yeah, I was about to ask when you said never. It was like,
yeah, that's why
2005. I'm
I was
quite sure you
qualifying
can do
that. Qualifying that, but no, but I mean, pre-COVID, you had to have at least a 580. So.
I know a lot of broke people, so, you know, just asking.
Well, I mean, I think that's a good point, though. I mean, you're going to run into people that have a desire to have their own home. And, you know, obviously that's the goal for us and as you as a lender. And they aren't, you know, they may not have this information to know what they need to do to get there. So having that advice to them is important, I think. And then also understanding, is there anything out there that supports people outside of the mortgage part, that supports people that are looking for ways to get into homes? Are there special programs out there? Is there guidance out there that we can offer to, you know, point them in the right direction as they start to get to this point where they're looking to purchase a home?
Yeah, there's a Georgia Dream down payment assistance program. And if people have if they're in certain occupations, that program will make sense. If they're PINS program, protectors, educators, nurses. So if they're firefighter, policeman, or military, if they're in the school system, if they're in the medical profession, there's $7,500 down payment assistance. So that program can make sense. It has, you know, there's some guidelines to be able to qualify for it, but there is that. Interesting thing, there's talk of possibly next year there being a $15,000 first-time home buyer credit, and that's a great idea, but the problem right now for most people is they can't find a house. There's going to have to be a lot more inventory on the market before anything like that really makes much of a difference.
Yeah.
So I mean, there's several. I mean, it sounds really good, but when it's put into practice, it's going to be like, wow. That was a lot of noise, but not a lot of effect, because if you can't find the house, it doesn't really matter how much money there is out there.
Reid, theoretically, if they did put something like that into effect, $15,000 first-time home buyer, could that $15,000 be used as cash at close?
Oh yeah, that's what it is. That's the preliminary talk is that is what it'll be. And this is where it's different than in 2008 or 10 or whatever it was. There was a first-time homebuyer tax credit, which was a $7,500 tax credit, but it didn't come into effect until you filed your taxes the next year. This one, what they're talking about is different. It's actually a credit that will show up at closing and it'll count toward your cash due at closing. So it'll be interesting to see how this one pans out. But again, until inventory changes, I listened to a podcast this morning about there's a lot of forbearance folks that have been through forbearance on their mortgages, and they're 4, 5, 6 months behind. And they're saying that this is eventually going to lead to an increased number of foreclosures. And like the guy said on the podcast, he said, "Man, I know this sounds like I'm being heartless. I'm not." He said, "I don't want anybody to lose their house." He said, "But the reality is, whether we won't like it or not, it's going to happen." He said, "So that could increase some of the first-time homebuyer inventory, levels. Who knows?"
Yeah,
Something's got to give, because we're like 1.2 months supply right now.
Yeah, that's usually what I do when I'm at the gym. I put my earbuds in and listen to some random person talk about random stuff about, what's going to happen next year. But in reality, if the forbearance stuff, people start being able to foreclose next year, that's going to create, like you say, double, possibly triple the inventory. Then your buyers are going to be able to actually find houses. It may actually help the housing market short term, especially as far as real estate agents are concerned. Worst case, it may be a 3 to 5 year plan to where it starts going back down, but I don't think we're really going to see much fall off next year as agents.
Well, I'll tell you, when in those years, 11, 12, 13, 14, 15, one of the reasons that a lot of first-time home buyers were able to buy houses was because somebody else had lost their house. I mean, it's sad, and nobody wants that to happen. And I'll tell you this, the banks don't want to foreclose. They do not. It costs them money every time it happens. They want people to keep paying their mortgages. And I don't know exactly how all that's going to pan out, because it has been a burden on mortgage servicers. Because what happens when a loan goes in forbearance is, Mr. Smith is not making his monthly payment every month, but the mortgage servicer still has to pay the bondholder every month. He's got no money coming in, but he's got money going out. So at some point, that's going to have to stop. I know that a lot of people right now they're modifying their mortgages, and like if they're 4 months behind, they're working with their lender, they're proving that they can make the payment, and they're adding that time at the end of the loan, and it's bringing them back to current. That's the best case scenario. People stay in their houses, they get back on track making their payments. And I don't know, I guess it would have to be a circumstance where forbearance had ended and the person still couldn't make their mortgage payments. In that case, I guess when the moratorium on foreclosures ends, banks may be, foreclosing, but that's not what they want to do, I can tell you.
I had 2 questions. The one is based on what you're just saying. We don't know what's going to happen, but we kind of are having all these predictions out there, and understanding what happened when the bubble happened. Do we have an idea? Because it doesn't seem like it always happens in all markets. Like, for example, near where I am in Marietta, I just didn't see a ton of foreclosures happening. So the inventory didn't really increase, at least on my side of town. So I'm wondering, when we talk about it, are we specifically talking about certain communities, certain areas that we're going to see that? Or what is your thought or take on the information that you know?
Well, in the northern arc, like you're talking about, there was an effect. I mean, there were tons of foreclosures in Cherokee, Cobb, North Fulton, Gwinnett, those areas, Paulding. I remember somebody talking about the PVC farms out in Paulding County, where builders had prepped the land to build houses, and all of a sudden they lost it, and this piece of property with pieces of PVC sticking up out of the ground. But that all was absorbed a lot faster than people thought. We did see foreclosures, but nothing like the numbers I remember, guys, there were, like, for example, FHA foreclosures. There were 3 companies that were handling the foreclosures and the marketing of those properties for FHA, for HUD. And so there was one law firm that was handling all those closings. And man, I spent so many Friday afternoons down inside the perimeter, somewhere over on the east side, sitting there at a law office with like a room with 100 plastic chairs, and people were sitting there waiting for their number to be called to go in and do their closing. And, you know, that's pretty drastic. I don't know that that'll happen again, because I think that the banks are going to try to avoid the foreclosures, you know, as much as they can. But I will say this, Daisha, by the grace of God, we do live in a very good area for real estate. People tend to have more stable jobs. I mean, I hate it. I hate it for people. I mean, to give you an example, the company I work for, the main charity we have is paying mortgage or rent payments for families who have kids who are terminally ill, because parents are having to take time off work to go be at the hospital with their kid, and they're running the risk of being evicted or losing their house. And the Silverton Foundation pays housing expenses for those people. So I don't want anybody to lose their house. I just hope they'll be able to continue to pay their rent, but I don't know. I mean, we don't know what's going to happen. The best thing that could happen is, you know, for jobs to rebound, the economy completely open up, and let us get back to cranking on employment, I think.
Okay. And then the last question was, we didn't talk about ARMs. Is that something that falls within the conventional category?
Well, there's jumbo ARMs. Well, even FHA technically had adjustable rate mortgages. They're not desirable right now. Fixed rates are so low that I haven't done an adjustable in the last several years. I mean, when you can think about it from a conventional perspective, you can do a 30-year fixed around 2.625 for 30 years. I don't think I'd be doing a 7-year ARM at 2.375, you know.
And what did that kind of creative mortgaging that got us back into that 2007, 2008 mortgage crisis?
It wasn't so, well, that's a great question, Joseph. There were two types of adjustable rate loans that were used back then. Your conventional adjustable rate loans, they had the caps on those loans, the amounts that they could adjust was very reasonable. Like they could only go up if a certain index, like at that time it was LIBOR. LIBOR's been done away with. Yesterday, they were telling us about the new index. LIBOR was the London Interbank Offering Rate. And so if you had an adjustable rate loan, when it came time to adjust, you had a margin that it was going to adjust above whatever that LIBOR rate was at that time. So if LIBOR was at 3 and your margin was 2, your loan would adjust to 5, and it only adjusted at certain intervals that you knew. That was the good kind of adjustables.
Right.
What really angers me, even now when I think about it, was the subprime adjustables.
That's killed it.
Holy cow. And guys, there were people that were, they made, and it wasn't, I'm telling you what, I don't know, have y'all ever seen the movie, is it called The Big Short?
No, I never seen it.
It describes what was going on.
Movie.
Yeah. Well, I want to tell you, and some of you may know, there were mortgage brokers that had a sphere of influence. There were mortgage brokers that would go to their church and they would refi hundreds of people that went to their church. They became known, hey, he's the mortgage guy at our church. And these were typically people who they weren't really savvy. They didn't understand about the loan they got, what it would do. And they would put them in subprime ARMs, and they were called 228 and 327 ARMs for the most part. And you could get one of those loans if your credit was horrific. And so you do a 228 ARM, that means that the interest rate's only fixed for 2 years. And after that, it starts adjusting. And what some of those mortgage brokers would do is they would do a 228 ARM with a 3-year prepayment penalty. That meant that if the person refinanced before the 3rd year, they had to pay a penalty. And you know why they would do that? Because they made more money at it. I remember rate sheets, but I was doing loans back in those days. I remember those rate sheets where, you know, I could name some of the companies. It showed you the interest rate, and it showed you your compensation beside it. And then it showed you your compensation if you had no prepayment penalty, if you had a 2-year prepayment penalty, a 3-year prepayment penalty, and your compensation was higher and higher and higher the longer the prepayment penalty placed on the loan. And there were people that were going into the main example that I heard about was people going into their houses of worship where you should have been able to trust people, and they were just churning those loans because say they did them with no prepayment penalty, but every 2 years they were going to come back to refinance. I did a handful of subprime loans, and it was for people that absolutely could not get any other type of loan. And the conversation was like, Mr. Smith, if you're bound and determined to buy a house, there's only one kind of loan that you can qualify for. Now I want to ask you, I know your credit score is 550. If over the next 2 years you can get your credit score up to a 580, I can put you in an FHA loan, fixed rate, and you won't have to worry about it anymore. Oh yeah, we're going to do it. We're going to do it. What do you think? Most people didn't. But yeah, so I don't honestly, Joseph, I'd be stunned if we ever got back to those loans.
I hope not.
And I hope not. Me too, man. Me too. You can't bank. Anybody who is banking on the goodness of human nature is really making a big mistake. Because if you give people the opportunity, at some point, if the money's enough, they're going to do wrong. That's just my opinion. Maybe that's a pessimistic view, but I do believe that people are naturally sinful, and that's why we have checks and balances. That's why we have laws.
Unfortunate. Reid, real quick, if there was like 1 or 2 pieces of advice that you would give someone who's seeking home ownership for the first time but looking for a mortgage, not really savvy, what advice would you give them?
I think, Joseph, the first thing that I would say is I would have them really sit down and figure out what their comfort level is with a monthly payment. Because when the rubber hits the road, that's the thing that matters. You can talk about purchase price all day long, but the real issue is what is the amount that you feel comfortable with writing that mortgage check every month? Because that's what's going to determine whether you can stay in the house or not. And I would say, okay, Mr. Smith, you're saying that you're comfortable with $1,300 a month on your monthly payment. How much are you paying in rent right now? Okay, well, that's about what you've been paying in rent the last 3 years. That makes sense. And you know, I don't like to see people stretching too much. Now, that's not my job to try to talk to them. I mean, I want to have the conversation and help them come to that decision. But anyway, so that's one of my first questions with the person is, what amount are you comfortable with? Second thing I would be asking is what's your source of down payment? Do you have money saved? Do you have a relative who can help you with the down payment? That type thing. And then probably the third thing would be, what kind of property are you really going to be comfortable living in? Like, okay, I want to buy at $170,000. Well, Mr. Smith, the only thing you can get at $170,000 in Cobb County is a townhouse. Oh, well, I've got 4 kids and 2 dogs. And a townhouse might not work for you. You know what I mean? So helping them think through that. So that way, guys, when you put them in the car, you're not wasting time. That buyer consultation that you do is so important. It's so important because if not, you're going to everything that pops on the market, they're going to want to go see. I mean, it's just the way we are, right? I mean, and there's people who, you know, they've been watching enough HGTV, they want to go look at houses. It's like their hobby. Well, that's not your hobby.
Right.
Yeah, that's why I got into real estate. I like looking at houses.
Well, it's a cool thing. So it meets both of them, but you don't want to be taking this Mr. Smith. We've been giving him a bad time this whole talk, but you don't want to be taking Mr. Smith to go see 80 houses. And trust me, it has happened. I've got a realtor this year who the client went under contract on the 67th house that they went to see. That ain't good. And sometimes you can't do it because that's the way people's brains work. And I don't think this was a case of not doing a buyer consultation, but I do think that can help you a lot to really hear. It's that thing of, you know, seek first to understand, asking good questions, and then stop talking and let them talk. Let them talk because I'll tell you, they're going to say something and you're going to go, now, Mr. Smith, hang on a minute. You said so-and-so. Well, that tells me this. What do you think about that? And you're going to go somewhere that you might not have gotten to before and find out and really get that thing zeroed in. This is the type of house that's going to be best for him. And I hope, like the Dickens, that we do get, I mean, we could go quadruple the inventory we've got now, and those houses would still be selling. The big issue is jobs.
Yeah, a balanced market, 6 months, right?
That's right.
So
That's
we're
right.
at 1.2.
1.2.
Yeah, we got a ways to go.
Yeah, absolutely. Well, guys, any more questions? It's been a privilege meeting y'all. Julianne sent me the list of Sri and Lamar are on here, but don't have their emails. I think I've got them because I have a roster, so I can get that. So I will send you guys anything y'all need from me. I'll email y'all. Julianne actually looks like she emailed all y'all on that too. So anything I can do for you, I'd love to help.
Awesome. Thank you, sir.
Thank you.
God
It was
bless
very
you
helpful.
guys.
Thank you.
Thank you.
Thanks,
All
Reid.
right. Talk to you soon.
Thank you. Bye.
Bye-bye.
Great.